Hey folks, welcome to another video. In this one, we'll try to cover a lot of topics. We'll talk about what's going on in the global macro, why are commodities running, what's in it for Indian equities, and how to best play the ongoing volatility, right? So the steep rise in commodity prices have brought gold back into the mainstream, which is the typical post-rally retail behavior. A lot of people think that the jewelry consumption is what drives the gold prices, but it doesn't. It barely scratches the surface. In fact, the relentless gold holding by the central banks around the world is what's driving the current rally. So U.S. investors have typically had 2 to 3% in gold holdings, which is now being advised to move to 20% by Morgan Stanley, which is a major shift. And with this shift, we are talking about billions of dollars, right? So let's say even if this number goes to 5-10% in the next couple of years, it would trigger a major supply vacuum for gold, right? Because billions of dollars are being moved from financial assets to commodity, right? And this could trigger the next commodity rally. Now, quite disconnected from the this year's global rally, Indian markets have significantly underperformed relatively. German markets have topped the charts. South Korean and Chinese markets have also closely followed. Not to mention, US has of course done well. The problem with India is that our nominal GDP has been 8.8% last quarter, uh, and it has flattened since last couple of quarters. So a single digit nominal GDP cannot sustain elevated valuations which the Indian markets have seen for prolonged periods. Now, also last year China announced financial stimulus, which awakened the Chinese markets, which were in a long slumber. This made sure that the majority of the fresh capital that's coming from the West and the global East shall end up in Chinese markets. Also, AI has been the talk of the market since almost a year now. Of course, US has a lot of AI stories. China has AI stocks. South Korean markets have AI stocks, but India does not have any AI story. Therefore, a lot of capital that could have come to India did not end up in India, and India also faced a lot of capital dry up, FII capital dry up, right? So these were some of the reasons why India underperformed. Of course, the unstable rupee was also a big contributor. Now coming to US, their dependence on the stock market has always been very high, mainly because 20% of the total US tax revenue comes from capital gains. And capital gains is, of course, a byproduct of the markets doing well. So this means if US markets fall and stagnate, this could deeply threaten the US fiscal position, right? Meanwhile, the US corporate growth, which originally grew on consumption based demand, has recently shifted into AI spendings, right? So AI spendings have outgrown the consumption based spending, right? And slowly the US AI based economy has become circular, right? The big seven have grown so much in size that they've started to eat from each other's plate, simply because the total addressable market size is not that big compared to what these companies have grown into, right? Now, Nvidia invests in OpenAI, and OpenAI in turn uses that money to buy chips from Nvidia. So this essentially means that there is money looping happening, and both companies enjoy increased valuations because of the stories that are built around them, right? Similarly, Amazon has invested in Anthropic, and Anthropic uses that money to host their infrastructure on AWS, right? So the strong interdependency has fueled this AI bubble. Um, this bubble can, of course, continue to become bigger as long as the cost of capital is low. But the moment fresh capital inflow dries up, these stack of cards, can fall like anything. Right. Also, due to the sheer size of these companies, the S&P and Nasdaq no longer represents the entire U.S. market. Right. In fact, the top 10 companies now account for 40% of the overall market weightage. Right. So the big seven have has way too much weightage in the U.S. index, right? And due to this, we have seen some unprecedented events like nearly 55-60% of the markets ending up in negative, but the entire index was positive just because the top seven companies did well. US has slowly become more inward looking and is encouraging countries to um, which were originally under the US military umbrella to manage their own defense. Simply because US has way too much debt, close to $38 trillion, and it cannot afford to do charity global spending, which it has been doing so far, right? Now, in the West, we see a generational decline unfolding before us, socially, economically, and I'd say morally too. Inflation and lesser job opportunities shall mean that in the West, most of the current generation will probably do worse than their parents, whereas the demographically younger countries shall slowly enter their prime, right? So, US, which has already been burdened by debt, as previously discussed, is subtly encouraging inflation to rise so that they can inflate away some of their debt, but such transitions are never possible. So we can expect going forward, we can expect some more global proxy wars, power shifts, market volatility, and rising global military spends. um, all of this strengthens the case for holding tangible assets like gold more, right? It is often said that the power production and power consumption is a great indicator of how well a country is doing, right? So if we see how Indo-Asian countries are doing and how the power production has grown in those areas and how the West has stagnated, a picture emerges where China is now standing head to head with US and has actually beaten US in a lot of areas, right? Now, US, of course, the US tariff tactic has not worked on China as they choked the rare earth supply, which basically showed that US is no longer in the commanding position when it comes to negotiating with China. Now, ever since fiat currency was detached from gold, the global debt has ballooned like anything, right? Nearly all of the countries are running fiscal deficits, which means they are basically borrowing from the future. Now, when there were gold backed currencies, countries were forced to make real economic growth, but now they simply print money to manage expenses, right? Which has led to enormous amounts of fiat currency in circulation, which far exceeds the real gold reserves these countries have, right? You know, which means that the fiat currency is slowly becoming nonsensical day by day, right? Although the global trust has always been with USD ever since the 1970s, it is slowly waning away as the US continues to misuse its currency, right? The current U.S. fiscal deficit, stands at 7%, which is seen during war times, right? But this is the new normal for U.S. and it's not correcting or normalizing anytime soon, right? It's a theory that as trust in USD erodes, both gold and stable currencies, which may or may not include Bitcoin, may emerge as the new reserve currencies, albeit temporarily. Um, the central banks across the globe, that's why are you know accumulating unprecedented amounts of gold. Now, gold is a very difficult asset to predict, but here are two major theories that I've read about so far. First is that gold has had these kind of run-ups in the past where it jumps multifold in price over a few years and then stagnates for several years after that. 1980s to 2000 is a good example where gold price of gold stagnated for 20 years. Similarly, in 2011 to 2018, where it again stagnated for around 7 years, these were absolute zero return periods. Now there are news that silent trade deals are happening between US and China, simply because Trump cannot continue to be the showman he has always been, else he might end up losing the House. With the settling trade deals, gold may also settle because the volatility is going to be over, the uncertainty is going to be over, and gold may settle after the current rally cools off, right? Now, the other way to look at it is that we are living in unprecedented times. The global trust on USD is the global trust in USD is fading. Central banks are holding unprecedented amounts of gold, and we are living in unprecedented inflation levels in the West too. So when US seized the Russian foreign reserves, that was the moment every central banker across the world blinked, right? Um, if they are doing it with Russia, why can't they do it with us? So now the foreign reserves for every country is held by a custodian. So the foreign reserves of Russia, let's say, were held by, let's say, JP Morgan, right? So US can have unfair advantage over the foreign reserves of any country, right? So that was the day many central bankers started diversifying beyond US treasuries. China has consistently been the top gold producer and the top gold buyer globally, and it's a theory that China wants to back CNY with gold, so that it becomes a new reserve currency, which at least the BRICS would accept. Now, US is unlikely to join the system simply because China and Russia are the top gold producers, and that's why is a lot more likely to look for alternatives in the case dollar trust fades away, right? US is now seeing classic case of stagflation where they're seeing inflation, but there is no real growth, and inflation is simply being allowed to pay the debt, right? So this theory also suggests that if gold is to regain the reserve currency position, then the current run up is basically nothing to what we might see, because too much money printing has happened, and which is basically beyond the current gold value. So if we see the graph on the bottom right, we can see that how the job openings in US has always been in resonance with the S&P growth. But something happened on 30th November 2022 where these graphs have started diverging greatly. Now, on November 30, 2022 was the day when ChatGPT got introduced, right? Immediately, it did not start eating up jobs, but it gave a strong signal to the big corporations that how this might unfold, right? So the, the new job openings in US have greatly started to get disconnected with the real S&P growth since 2022 end. Now, India has underperformed strongly compared to the global markets due to the reasons I've talked about before. But despite these, India has one of the best macros globally with a superior corporate health. Banks are doing well, their NPAs are low, uh, and even PSU banks are doing pretty well compared to what they used to do. And it's true that Indians have greatly benefited from the gold rally because Indian household hold a lot of gold, right? And the fate of Indian equities for the short term simply relies on how the West manages their debt, because domestic inflows alone cannot, can only hold the markets, but they cannot send the markets rallying, right? Now, silver has always been the more volatile cousin of gold, and actually, it's currently running cheaper than its historic levels because silver has always been 2% of gold's price. So, although silver has run up a lot, it can continue its merry way simply because it is running cheaper than its historic levels. But silver is a highly unpredictable asset. Now, if several bad events happen at once, let's say US recession, capital flight, and war, let's say if all three happen at once, then emerging markets can face further sharp selling, right? However, if we are appropriately diversified across fixed income products, gold, silver, then we shall have the liquidity when equities get cheap, right? And that is basically the idea of asset allocation, uh, that that we can plan the weightage of assets such that it gives us the best risk adjusted returns. So when it comes to investing, I strongly feel that retail investors should spend time in taking macro decisions rather than micro decisions. Now, micro decision includes basically what stock to buy. Macro decision includes macro decision basically covers how much should I have in equity, how much should I have in other asset classes, right? Now, if we want to make a decision on our own, we can simply follow percentage based allocation across asset classes, which we can rebalance, let's say, every 6 months or every year. So, this will help us to with this kind of scenario. Let's say if an asset class which has run up, it shall be cut down, and the excess capital shall be moved into an asset class which has underperformed, right? Because every asset class has its own cycle. And if for passive investors, multi-asset funds can be a very good go-to product, because commodities have time and again proved that they can act as a safety net. And in fact, now commodities and have started to contribute to alpha as well, right? um, so that's all I had for this topic. Thanks for staying and watching till the end. Thank you.